Right. Oh, hey, there we go. Sorry about that. Welcome to the latest episode of Harrington Home Sweatin Money. Recorded on May, what is this, the 20th?
22nd.
22nd. Hey. We may or may not have ownership or other positions on the stocks mentioned on this show. Don't buy stocks based solely off what you hear from this podcast, and always do your own homework and research before investing in stocks. Of course, I'm your host, Kong. And as you heard earlier, my co-host is Gibson.
Great timing.
Yeah. It's always better whenever you're doing it like this rather than over Hangouts.
Sweet.
Yeah. Anyways, let's take a look at what's in the news. As a result of Carl Icahn's selling of Apple shares, his fund Icahn Enterprises LP hasn't been doing well. Now, as a result of having sold his shares, he has seen his fund ratings drop to junk status. Ouch. Any comments?
No, but I think your next slide is going to be very interesting.
Aha.
I'll comment then.
Well, Warren Buffett, through his deputies, bought shares of Apple. This goes against his whole avoiding tech stocks comment back in the day. So why is he buying tech stocks now? Let's look specifically at his comments back then during the tech stock bubble. Basically, he wasn't really saying he feared them because he didn't understand their business models. He really just didn't understand why most people were paying such a high price for them. Over the years, he's bought tech stocks like IBM. And this past November, he admitted to taking a $2 billion loss on his on this specific investment. If you look at the charts, he's nearly recovered from those losses. However, he's been slowly buying them since 2011. By those metrics, he's still got a while to get back to even. So how will his Apple and possibly Yahoo shares fare?
I don't know. First comment, one man's junk is another man's treasure.
True.
Second comment, I don't know, Warren. You're not doing so hot in your tech stock shares. Your original commentary about avoiding tech stocks might have been golden for you.
Maybe, yeah.
Yep. Respect the guy, but
in this case specifically, it was his deputies that pulled the trigger on Apple. So
that's true. Maybe some deputies should have been fired because it's like, what did I tell you about things I don't buy? Yet you still buy them anyways.
Well, I mean, he trusts them, so hey.
That's true. Can't micromanage your employees.
Yeah. I mean, so in effect, he gave him the approval. So, let's take a look. Meanwhile, David Einhorn of Greenlight Capital has followed Buffett's footsteps and grabbed shares of Apple, Yahoo, and Yelp. So,
sweet.
Now, we have mentioned before that Warren Buffett is interested in Yahoo as well, and note that Susan Decker, who used to work at Yahoo, is now president of the board of Berkshire Hathaway. She may have had some influence over this decision, but not much is being revealed, and it's not sure if they're actually going to pull the trigger over this purchase.
Don't know. Something need to be pondering. Although noticing about Apple's sudden drop in the share price. See, no matter how well you and I predicted, read the news and whatnot, we can never predict what's going to happen with these super rich people suddenly deciding to, hey, I'm going to sell my shares.
Right. And I mean, of course, because they have the buying power, every time they buy anything, it's going to move the markets.
Yep.
So
go up when they buy it and then go down when they sell it.
Yep.
Bastards.
Wish I had that kind of money.
Yep. The game's rigged for them.
Yeah, well, Microsoft is selling its dumb phone segment of Nokia that they had bought. Two companies, one a Foxconn subsidiary and another a Finnish company, will be buying separate parts. The Foxconn subsidiary will buy the brand, contracts, and the factory in Vietnam, while the Finnish company will buy the licensing rights to slap the Nokia logo on their phones. Microsoft will continue to use the Nokia brand for their smartphones.
How smart is it when your phone only runs out of batteries within a day? Nokia's old dumb phones, man. You have a week-long battery life, insane durability, and great reception, audio quality.
Those things are bulletproof. Oh, I mean, they prevent bullets from getting to you, at least, because they're so thick.
There you go. Look at that. Another selling point.
There you go.
Phones that protect you from bullets.
Exactly.
I'm not saying they're bulletproof. They will provide some sort of protection, but maybe not as much as you would like. But still, good selling point.
Yeah, I mean, yeah. Granted, your phone's gonna be dead, but I mean, if someone shoots you, but then, hey, it's if they shoot you right where your cell phone is, then hey, it was so cheap, you could buy another Nokia.
That's true. as opposed to a $700 smartphone.
Dude, honestly, I mean, there is a lot of nostalgia to brands like Nokia, like, you know, being able to do things like make your own little tunes on your phone or something like that.
That's true. And then I think in terms of burner phones, really, I think there's still a market for that, you know.
Oh yeah, like especially in places like Hong Kong, where for some reason or another, certain companies still can't penetrate certain areas.
Mm-hmm.
So there's actually some phones where you have dual SIM card slots.
Yeah.
Yeah.
Yeah, I think, I don't know why you have dual SIM cards, but I think
Drug
still very cool. Huh? Switch between the SIM cards.
Yeah.
You know?
All right. Well, anyways, so in the U.S., overhauling the eligibility for overtime, which currently allows people who make $23,000 a year to be classified as managers and thus exempt from overtime pay. The original proposal was to up it to about $50,000, but the final version of the law was lowered to a little over $47,000. And President Obama signed it on Tuesday. The bill will take effect later this year.
Great.
Yep.
Manager has lost all meaning.
Well, I guess this goes back to that minimum wage debate that we had talked about before. I can't remember if we have additional slides to continue talking about it. I don't think we do.
Sure.
Well, I guess we'll figure it out when we get there.
Yep.
Actually, yeah, we do. We'll talk about it. I should have rearranged the slides, but whatever. We'll talk about it in a bit.
Sure.
Yeah. Anyways. So let's see. Back to BlackRock. Now, we've discussed in the past the debate around China's economic pivot from a manufacturing-based economy to a consumer-based one, and how the provincial government debt issues, which may affect these policies. Now, analyst at BlackRock says that some of the central government and People's Bank of China recommendations hinge on this pivot. Now, BlackRock's Lawrence Fink says that while it may actually be successful, most countries who make this pivot tend to suffer a recession, and he's kind of down on China right now. So he talks about the issues behind continuing economic growth rates at roughly 6% and keeping the balance sheets high. However, he did note the macroeconomic issue of Chinese tourists leaving China for Hong Kong and places outside the country just so they could buy things in droves due to the complicated taxing system that China uses currently. Now, I mean, I've been harping on this for a long while. I mean, first of all, the tax policies are frigging ridiculous. How is that when these products are made in China that they're still going to Hong Kong, flooding Japan, the U.S., wherever, and buying the products because it's cheaper? I understand that like certain Chinese companies are only authorized to make things for certain markets. Like some companies can only make certain products for foreign markets, and some companies can only make it for like the domestic market. That's part of it. But there's also an issue with the taxation system. It should not be any cheaper to buy things in Hong Kong than it is to buy where they are originally made. Now I understand that there are QC issues with China. I mean, if you're talking about food or other issues, but other than that, it should not be any cheaper to sell imported products from in Hong Kong than to sell products that are originally made in China. It doesn't make any sense.
Well, the answer to that question is really tariffs,
Oh, yeah, of course. Tariffs. No, it's not just tariffs, but it's also the entire taxation system and VAT system that China uses is just, it takes it at every level, right? Mm-hmm. Because why is it? Because every step of the way, the government says we don't have enough money. But why do they not have enough money? It's because everyone's cheating on their taxes, first of all. But second of all, because everyone knows that money's going to go to corrupt officials. So no one really wants to give their money to like these people because they're really just raking it from you. They're stealing it, basically. And, I mean, on the other hand, let's get back to the economic pivot. This is one of the things that I've actually been saying too. Like, China, yes. Personally, I don't think that it's going to make that successful pivot to being a consumer-based economy, or at least that's, I'll leave that aside. But I don't think it's going to be successful. But even if it does, I think he's right that it will definitely go into a recession for sure, for at least for a certain amount of period. I mean, if you look at Japan, perfect example, their bubble bursted, and everyone's afraid of that scenario in which Japan tried to repivot into a consumer-based economy, and it wasn't able to do that. That's why it led to its 2-decade recession, pretty much.
Mhm.
I mean, you had a slight rise here and there, but they weren't anything significant. Look at it now. The U.S., on the other hand, was successful. Now, part of that, however, was the fact that they actually took a lot of those old manufacturing jobs and just basically dumped it all in China, and then managed to successfully, retrain whatever workers they did have. However, there are still issues with that. And even then, they still had to go through a short period of a recession. I mean, that's exactly what signified George Bush's presidency, is he was dealing with this recession, and that's why he wasn't reelected. That's how Bill Clinton came to power. So,
Yeah, not much you can comment on historical facts there.
okay, let's move on then.
All right.
So that rumor about Wendy's replacing workers with kiosks that we talked about last week, turns out it's actually not a rumor. The Brookings Institute is looking into how the raise in the minimum wage issues and Wendy's is in their sights. Specifically, the company is allowing franchisees to replace their workers with machines, the aforementioned kiosks. So not much details have been given, but the franchisees' purchases of these machines, is it going to be from the main company? I'm not exactly sure. Or is it going to be from some outside vendor that has to meet the company's guidelines? I don't know.
It doesn't matter really how they get the machines, as long as they get the machines, however they ultimately handle it.
Do you think it's actually going to be cheaper?
Well, just kind of like government, like they're an organization that does a specific task, and Wendy's is the best business of doing restaurants. They're not going to create their own technology division, develop these machines, so they're probably going to just buy from the best vendor that promises to make them. And in fact, making these point of sales machines is not anything complicated.
Right.
It's just a damn button, like a touch screen, and then some options to select from that goes into a cart, and then they pay for it.
Now, last week we did mention something about their IT infrastructure being increased, and this is most likely for that purpose. So this is going to be very interesting.
It can change a lot of things, but maybe they already have it that way too. Like maybe they have some sort of reporting system that all the cash registers run into a machine, that computer feeds it all the way up to central, and then they process the flow of how other restaurants are doing and whatnot. Or
Right.
maybe they don't. I don't know. I mean, if it's the IT company, I would say, yeah, chances are maybe. But then if it's a restaurant company, I was like, maybe not.
So, well, the IT is going to be in-house, it seems like, unless there's a contracting company that they've specifically had a contract with to deal with this stuff. Now, that would be interesting, but it does sound like, at least from their press release, that it's actual internal hires, I believe. So,
I mean, it's okay. The same point is I feel like they might, a vending machine company or a like IT hire might make sense, just because it doesn't seem to be worthwhile to develop technology and only use it for your own company, right?
Right. Who do you think this company is? Because we got to get their stock.
I don't know, but finding out would be useful, I guess.
Yeah, well, homework, I suppose.
Yeah.
All right. Now, so if you are a truck driver and you had retirement on your mind, you probably had some money invested in the Central States Pension Plan. Unfortunately, they may not have enough money. Now, normally, if a fund runs into trouble, the government would come in and help pick up the tab, but even for the government, this is too big to handle, and even if they could, the amount that would be handed out would be minuscule in comparison to what should have been given out had this problem not been mismanaged. Looking at the website, they made it very clear these guys are done. More about these guys in a bit. Now, last week we talked to you about Donald Trump and how he was trying to remove foreign influence by renegotiating loan terms with other countries, but would actually end up screwing over Americans, especially state and county workers across the country, because of how much of these public entities hold federal debt. Now, there are specific numbers of companies that are holding on to America's cash as a form of safe assets. They've doubled their holdings in the past 8 years, and some of these names might be familiar. There's Apple, Microsoft, Alphabet or Google, Cisco, and Oracle seem to be the top 5 companies, all tech. The company behind Oracle is Pfizer, a pharmaceuticals company. So if you don't feel like investing in cash, would these companies be a good alternative?
I don't know. I mean, a lot of these tech companies goes back to Buffett's story altogether. So it depends. Cash isn't necessarily something you invest in; it's just something you hold on to. And then, if you have the ability to do something with it, do something with it. You can't, then just hold on to it. That's roughly the role of cash.
All right.
Like sometimes when the company issues out dividends, they literally ran out of things to do with it. So like, look, we don't want to, risk the money in the market right now. It's better back in your hands. So we're not responsible for that money.
Okay. Monday, the housing market index was released, and unfortunately for renters, housing is still on the rise and will keep rising. The saving grace, however, is that more construction for houses is coming online. Now, specifically, I was saying it's sad for renters who are actually looking to buy homes. But yeah, if you're renting, I guess rent is going to be cheaper.
As long as you have rent control,
yeah,
then you're fine.
Yeah. Well, Friday, the existing home sales numbers were released, and altogether, home sales beat out analyst expectations for April by 50,000 units. So people are buying homes again.
Great.
Yeah, Tuesday, the consumer price index rose to 0.4%, when analyst expectations were only 0.3%, especially when March was only up by 0.1%. Now, this means inflation is on track with Fed's estimates, pending job growth. People are rumoring that the Feds may raise rates in June.
That's good news for the economy in a way, and bad news for the stock market.
Yeah, well, on top of that, to add to things, good things for California, I suppose. One of the biggest states in the U.S., third in landmass, I think, and number 2 in population. California has added over 59,000 jobs, bringing unemployment down to 5.3%. Also on Tuesday, the Federal Reserve released its industrial production report, and things were looking good. Part of it was due to colder weather across the nation, which boosted energy demands.
Makes sense.
Despite being in a slight deflationary environment for Germany and the EU as a whole, Volkswagen which was slapped with fines in the US and is most likely going to face fines in other countries, will be raising the pay of its workers by 4.8%. They said that this will actually help stimulate the inflation in the country and be good for the economy. They also said that the workers should not suffer for management's decisions in cheating emissions. The pay raise will come in 2 stages, 2.8% in September 1st of this year and another 2% in August of 2017.
That's nice of them.
Yeah.
I'm not sure how the shareholders are going to react to that, but
oh, man,
that's nice of them.
I'm pretty sure they're not happy.
Yep. Not only did you just cost us a ton of money in recalls and cheating and revenue, you are now going to increase your expenses.
Right.
Perhaps this is like a CEO's like super high level way of getting out. So you know what? Before I leave, I'm gonna give myself a raise.
No. None of the senior management is getting a raise. It's only the lower workers.
I hope so.
Yeah.
Because I'd be extra pissed.
No, I mean, regardless, I mean, it's still going to weigh in on the shareholders. I mean, like, they're already their stock's getting hit already, and then on top of that, you're raising the expenditures. I mean, like, I'm not saying it's a bad thing for the workers. It's definitely good. Yep. I mean, it would just suck if you're an investor.
I think so.
Good thing I don't have any stock in them. So, anyways, last week we mentioned how China was denied some special trading privileges with the EU because of their anti-competitive practices known as dumping. You can check out that link for more info. Now, we also we had also mentioned a bit of that in our last episode. So, now the thing is that the EU, not just the EU, but the US is making critical statements of China's steel industry for dumping their products. And they've been doing this for a while, actually. But now it's just the voice is getting a lot larger. So,
all right. No comments. I mean, they've been doing it for quite some time, and we just discussed it last week.
Yeah. All right. Anyways, let's see. Let's take a look at the week in review. This week's performance, you can see things start to fall on Tuesday. Wednesday, they tried to pop back up, but ultimately fell on Thursday. And Friday, things rose back up. The ending score of the week was the Dow Jones ended at 17,500, raising up 65 points. The S&P 500 ended at 2,052, which rose 12 points. The Nasdaq ended at 4,769, and it went up 57 points. So let's take a look at the international markets. Last we checked, Australia is down. According to the Wall Street Journal, hedge funds are betting against Australia's 4 biggest banks because they are racking up rising bad debts and their earnings have been falling. And investors fear a property market downturn. Over the years, Australia, just like many other places around the world, have seen property markets skyrocket because Chinese investors have been buying property left and right. So they'll come back in. Are they going to come back in and swoop up more property while the market is down? We have yet to see. But I believe this is also an election year for Australia as well, and they've been dealing with other political issues too. So we'll see how this is going to turn out. New Zealand stocks aren't faring much better. In the midst of rising shipping costs for their log exports, third largest commodity export behind dairy and meat, the thing that has offset this decline in the thing that's offset some of these issues is the decline in the Kiwi dollar. However, that also means that their currency is weak. So
yeah, although they should probably get more exports out.
Yeah. Now, taking a look at the Nikkei, also in the red. The dollar fell against the yen when it was learned that Japan got a larger than expected trade surplus in April. Currently, the $1 is about 109 yen. The theory goes that the higher demand for a country's good, the higher demand for its currency will be as well. However, if the yen continues to rise to higher levels, as it did a couple times recently, that demand might drop. And that's not what Japan wants. However, the U.S. is putting pressure on Japan to not intervene in its currency and is urging them not to weaken it.
I don't know. I mean, they could just take a page out of the United States book. Interest rate manipulation, but they're already in the negatives. So, what are they going to do, right?
Yeah. The Kospi, Korea's Kospi, was dropping, but then shot back into the black. Very interesting. Part of the reason why the Kospi is up is because of government tax policies, which encourage companies to pay or increase dividends, which if you're an ETF that has some Korean companies in the fold, this might not be bad if you like dividend stocks. Now, the Shanghai Stock Exchange managed to maintain an upbeat day thus far. They have a new man in charge of their stock exchange. Whoops. No. That's not really telling much. Because when you take a look at how their state-owned enterprises, as we had mentioned earlier, they're getting hammered by countries like the U.S. and the EU because of worries about their country's dumping policies, very anti-market policies, anti-free market policies, I should say. Mm-hmm. It's kind of hurting them. Now, the more likely reason for this rise is because they published new rules in Shanghai and Shenzhen stock exchanges on how to use their trading halts, which were used far more often than compared to most other nations. And it increased investors' anxieties last July, and I think they used it again back in this past January. So, yeah. Taking a look at Taiwan's TSEC, it's up as well. Although it's hard to say why that's the case when you have China's gun barreling down your throat. They were angry at Taiwan's newly elected president, who was just sworn into office this past Friday, when she didn't outright say that she recognized the 92 consensus. And that's another podcast for another day. But anyways, I'm not sure why Taiwan is up. Maybe it's because a lot of Taiwanese merchants that are doing businesses in China, since they have business in China, then they're naturally Taiwan stock market should be up.
It's up by 0.25%.
It's not much, yeah.
By the end of this cast, they might be back down again altogether.
No, that's not Taiwan. Taiwan is up by 2%.
I see, 2%.
Yeah, that's actually a pretty huge jump.
That's sizable, for sure.
Yeah.
Don't know why.
Huh.
Perhaps Americans are investing in foreign countries now since their buying power just went up.
Maybe.
Who knows?
Well, let's see here then. Let's go back to, come on. All right, well, let's look at Hong Kong. Now, Hong Kong, which you saw in the preview, that is only up 0.25%, but it's still up. Now, the rise in stocks in Hong Kong and in Shanghai, however, are not believed to be a rally for the region, as people are still very pessimistic about China's economic viability, and they believe that they are in for a downturn. No further comments?
At least, well, I mean, no one's quite expecting an upturn for whatever reason right now, so...
Okay, well.
Yeah.
So let's go ahead and take a look at the playbook. Now, again, this is just a reminder. None of the following should be misconstrued as financial or investment advice. This is merely provided for documentation only. So my position in Cunningham Phillips, you're losing money. How could you? You have so many products that are being used by a bunch of people. What the hell are you doing wrong?
Well, any ideas?
No, none whatsoever.
No? Is it expense are higher than normal? Revenue is lower than normal? Like, such
Not
things
really.
could answer the question for you.
Well, I guess I'll have to take a closer look. Anyways, following in your footsteps, I took a dive into Disney, although probably not as big as you. I only had 10 shares. And yesterday it wasn't doing too good. Dropped a bit, so not yesterday, I should say. Thursday.
Mm.
It dropped a bit, and so I bought a little too soon from the bottom. But Friday, it did really, really good.
That's good. I'm glad for you.
Yeah, and then there was Dunkin' Donuts. Now, I can't remember why I decided to take a stake in them, but I think it was because their earnings report was about to come out, and looking at previous years, this was usually a time when they were making, they were doing pretty good. They usually start doing pretty good around this time, and it gets even better all the way to the end of June usually. And last quarter, they did so good, dividends were actually raised. So this quarter, sadly, not so much. They missed revenue a bit, but not by much. Still, the investors weren't happy, and after making some gains after buying them, I'd lost on Friday. So between Disney and Dunkin' Donuts in the past couple of days, their positions have reversed. And then, of course, there's Square, a bit big on you, and thought you were undervalued, and I had high hopes. How could you do this to me?
Told you. Short. Square. If I would have had to make a bet, gun point to my head, no. Short.
Well, let's hope that they get their act together.
All right. You always sell. I don't have hopes for that.
Well, now then on Friday, Square shares fell, and they fell pretty hard after making some slight gains on Thursday. Regardless, I still bought too soon. Turns out that one of the major stake owners with at least 10% was a man named John Giampetroni, and via his investment firm Rizvi Traverse Management LLC, he sold his shares, all of them. So yeah. Now, in doing some more, research, I guess if you could call it that, I was trying to find some sort of silver lining for them, and I found this 2015 article, which did a comparison of Square along with PayPal and other similar electronic payment businesses to see what's the difference and how each of them set themselves apart. Basically, the only thing that they set themselves apart in is just the market segments that they go after, pretty much. And there's really nothing new to reveal there. PayPal did buy out some other electronic payment schemes, and as far as like the small businesses, I mean, like most people, they're still using Square. I mean, unless you're doing business on eBay, you're really not using PayPal all that much.
Well, I would disagree. I think PayPal has a strong viability as a payment processing center. It's just
for small businesses.
Well, I mean, online in general, they have a strong online presence.
Well, yeah, online definitely, yeah.
But in terms of like brick and mortar business, maybe not so much.
But I mean, they're only one tiny investment away from being able to take on Square on that front, right? The same capital investment that Square made to produce the product. What is the selling point of Square? Well, Square gives you a card reader for free. Most payment processors ask you for some sort of like payment to buy the equipment or rent the equipment beforehand. But Square is just a little magstripe reader and an audio port, so it's quite convenient for that front. But if PayPal would offer the same thing, I don't know, then we can see that the market share that Square has right now can be continued to be chipped away.
No, it's more than just that. I mean, PayPal's device is pretty cheap. I've seen it. It's only about $20 or so. So it's not that huge of a difference.
$20 for free? I go with free, right?
Well, yeah, but even then, it's more because of the transaction fees that PayPal charges, and I think it's about a percentage higher.
I think it's 2.9% with 30 cents transaction plus 30 cents on the fixed fee.
Yeah.
So I doubt Square is charging a percent something. But then again, who knows? Square is losing money right now, so there you go. Maybe.
Yeah, well, we'll see.
Hey, as long as you're willing to operate in the negatives, all laws of logic does not apply.
Yeah.
It's like, but you won't make money on these transactions. It's okay. But you lose money. It's okay. You eventually run out of money altogether. It's fine. Okay, sure.
Well, hopefully that's not going to be the case. So let's look at your investments. Your position in Caesars. This is really interesting. Your position in Caesars Palace is actually, like, it's funny considering the history of the casino. It was actually funded by money that was skimmed from the Central States Pension Plan that we had mentioned earlier, which is facing insolvency problems right now. However, Friday, Caesar shares were actually up on announcements that they would restructure.
I don't know. I don't know how anyone else is reading it, but I'm saying, hey, it's edging closer and closer to bankruptcy. They're resolving things that are a question of whether or not the parent company would be involved in the bankruptcy. And if basically Caesar is allowed to get away with it, then any other company in the world can basically go, about the basically they could lump all the negative and all the expenses and all the loans into a newly created company and then just shove it into newly created company, let that newly created company become bankrupt, and then they just keep all the cash. So you could borrow millions and billions of dollars and basically keep your cash, shove the debt contract to the newly created subsidiary, and then just let it die.
Well, okay, so what were the put positions that you had on Caesars?
I forget. I think like 7. I think for what reason I concluded that at 7.5, it's when I would take like a $200 loss or something. It was not that big of a deal on this share. But then how I view it is that if it does go bankrupt, then I'm making $7 on those shares, which is more significant. I think whatever it is, it's like a $3,000 gain with a $200 risk. So I think that's a fair bet on Caesar, given the bankruptcy proceedings.
All right. Well, good luck on that.
Yeah, we'll see.
Yeah, I mean, I'm pretty sure it's going to happen. So
I don't know. Huh.
Well,
something funky is going on with this company.
Yeah. Well, let's take a look at the week ahead. The week of 23 to the 27th of May. Monday, we're not really looking at much. Tuesday, we're looking forward to new home sales. Wednesday, the FHFA house price index and the PMI services flash report, as well as the petroleum status report will be out. Thursday, you have the durable goods orders, jobless claims, Bloomberg consumer comfort index, pending home sales index, natural gas report, and the Kansas City Fed manufacturing index. And Friday, you have the consumer sentiment, and Janet Yellen's going to speak.
Ooh, this is going to be a rough week.
Yeah. Now, however, next Sunday we're not going to be recording, so we're going to cover what's going to be coming up the week after as well. So from the 30th of May to the 3rd of June, Monday, markets will be closed on Memorial Day. Chicago PMI Tuesday and consumer confidence reports will be out, followed by the Dallas Fed manufacturing survey. Wednesday, you have the motor vehicle sales numbers, Gallup U.S. Creation Index, PMI Manufacturing Index, and the Manufacturing Index. Construction spending will be out. Thursday, you have chain store sales, Challenger Job Cut Report, jobless claims, Gallup Good Jobs Rates, and the Bloomberg Consumer Comfort Index. Friday, you have the employment situation, the PMI Services Index, and the Factory Orders ISM Non-Manufacturing Index report will be coming out. So let's go ahead and take a look at next week's international markets. Japan's All Industry Index and EU Consumer Confidence Flash Report will be out. Tuesday, you have Germany's GDP numbers and the UK's Public Sector Finances reports will be out. Wednesday, you have the Consumer Climate and Bank of Canada announcements. Thursday, you have retail sales numbers for Italy. Friday, you have Consumer and Business Confidence reports. Sunday, you have Japan's retail sales numbers out. And then the week after that, Monday, you have the French GDP and Consumer Manufactured Goods Consumption Report, Swiss Leading Indicator, and then the EU Economic Sentiment, German CPI numbers, plus the Japanese household spending and unemployment rates, and their industrial production report will be out. Tuesday, you have the German retail sales numbers, along with the French CPI, followed by the EU's unemployment rate, along with the Italian GDP and CPI reports. Chinese manufacturing PMI and Japanese PMI manufacturing indexes will be out on Tuesday as well. What happens with all those other days, I'm not too concerned with right now. So, recommendations.
Well, I don't know. I mean, I'm starting to eye the markets for opportunities right now. I think part of one of Buffett's slogans has always been, or mantras that he's spoken, is that, you know, when a rising tide lifts all boats and a receding tide shows who hasn't been wearing their trunks or their shorts. But in a way, it's kind of, we kind of have the ebb and we kind of have the flow, or the flow and the ebb, or the with the markets right now. I think is a good opportunity for us to take a look at how all these various companies has reacted to the panic in the market and which ones have really stood the test of time right now and might be a good buying opportunity for these certain companies. At the same time, there is a bit of volatility from Yellen's interest rate hike, because an interest rate hike always kind of means that the economy is doing really well. They want to slow the economy down, and they want to encourage investors to basically save money instead of investing, or take the money out of the economy. So it might always translate to something negative for the stock market as a whole, just because it has a global, a macro level impact on the trading or stock trades. But yeah, but at the same time, it's like, well, if your company doesn't do well in the stock market when the economy is doing well, then maybe it's not a company you really want to hold on to anyways.
Right.
You kind of want a company that goes well with the economy. So it might be a good time to look around the market and just see which companies have just been doing like stellar in the past like year or two, regardless of, you know, all the macro level impacts.
All right. Well, one of the recommendations I'm going to say is also taking a page out of your book, is to look at Warren Buffett and how he deems stocks to be worthy of buying. After looking at the management team and deeming them capable leaders, will they buy back their own company's stock? That's a good question. So if so, that's a sign that they're confident their company is, you know, well prepared. Considering this, it might be worth following in their footsteps and buying as well before business actually starts to pick up and everyone else is catching on.
That's a valid point. I mean, if the company does expect themselves to actually be doing better, now would be the best time for them to buy back the stock, because then in the future it'll be more expensive.
Yeah, so now, although you should also be aware that this may not be the case. Sometimes in order to gain voting rights or the right to sit on a company's board, an investor has to own shares, thus buying them. Or sometimes they want to diversify and sell shares, or maybe to fund a divorce. They might be forced to sell shares in that case. Now, the latter two issues are usually misread by investors who think that this may be a signal for them to sell as well. A couple months ago, Warren Buffett sold some shares of Walmart, which didn't help the stock prices, and I was not a happy camper at the time. People panicked, of course. Now, however, if you looked at his overall holding of the company from 2 years prior, the percentage of his positions in the company had actually increased. So he was only rebalancing his portfolio to loosen up some cash to fund his projects, as he had actually said.
Mm-hmm.
So another reason not to buy is not just based on the leadership of the company, but a look at major institutions and funds that also own shares in the company. if you follow their signals, you're probably already too late to get in on the real deal. So some would argue investors like Peter Lynch specifically buy stock that aren't owned by these big institutions, saying that they are probably overlooked. And when the big guys haven't caught on, it means they're undervalued.
That's very possible. That's very legitimate, and it also would indicate that these big institutions can't influence the stock on a way down because they don't sell that much all at once.
Right.
So that's a point. Can't disagree with it.
Ultimately, it's just different approaches at how you get to an undervalued stock. So
yeah, but chances are you're trading on the NYSE. Most of these stocks are institutionally owned.
Probably. Yeah.
Now,
so if you wanted to get in on this insider trading bandwagon, for some possible looks into insider buys and sells from companies from internal bigwigs, you can check out insider-monitor.com. But I noticed their information is about a week old. So if you're a quant out there and you have a nice algorithm that we can use, please let me know. And that pretty much ends our show for today. Thank you for listening. Once again, we may not have ownership or other positions on the stocks mentioned on this show. Don't buy stocks based solely off of what you hear from this podcast. Always do your own homework and research before investing in stocks. One more thing, our iTunes feed for some reason is down, but you can still subscribe to the RSS feed on our website. You can still go to the YouTube page and subscribe, and also we are now on the Google Play News. Thank you for listening.
see you guys next time.
Bye.